Everyone's talking about silver's 15% crash and the manipulation behind it, but nobody's telling you how to actually profit without getting liquidated. I'm going to give you the exact strategy, step by step, the same approach that let me survive Monday's bloodbath, while others got margin called into oblivion. This is the playbook that works when markets are rigged against you. Silver dropped 15% on Monday, February 3rd, 2025. The CME hit traders with 8 margin hikes in 8 weeks. Paper silver trades at $72, while physical in Shanghai is at $100. You understand the manipulation. You know March 27th delivery is coming. You know physical wins eventually. But here's what you don't know: how to profit without getting destroyed first. Because being right doesn't make you money. Survival makes you money. That trader who predicted silver's squeeze, who called the 50% January rally, who understood the manipulation thesis, he still lost everything. Why? Because he didn't have a strategy for when they changed the rules. He didn't plan for 8 margin hikes. He was right about the destination, but the journey killed him. Let me give you the strategy that keeps you alive. I call it the 3/3 rule. You split your silver allocation into 3 equal parts. 1/3 physical metal, 1/3 cash waiting for lower entries, 1/3 options, never all in. 3 separate approaches protecting you from 3 different scenarios. 1/3 goes into physical coins or bars right now, not paper ETFs, not futures, physical metal you can hold. Why? Physical cannot be margin called. Physical cannot be halted by exchanges. When you own physical silver, you own the asset. No counterparty risk, no liquidation risk, no getting locked out while your position bleeds. You're paying a premium now. Dealers charge $4 to $6 over spot. Paper at $72 means you pay $76 to $78 for coins. That premium bothers people, but that premium is reality. Physical buyers value silver higher than the paper price. That premium is the market telling the truth. The paper price is the lie. When paper reconciles to physical, that premium becomes profit. Smash that like button if you're seeing why physical is the foundation. Drop a comment with whether you're buying physical or waiting. And subscribe because I'm breaking down exactly how to navigate this manipulated market. 1/3 physical locked in. What about the other 2/3? Most people see $72, think it's a bargain, and go all in. Then silver drops to 65, then 60, then 55. They're stuck. No cash to average down. They bought the first dip, not the final dip. 1/3 stays in cash, completely out, ready to deploy. Why? In manipulated markets, price can go anywhere. Fundamentals don't matter when institutions coordinate margin hikes. Physical shortages don't matter during forced liquidations. Price can disconnect from reality for months. If you're fully invested, you're helpless, but cash gives you power. Here's my levels. Silver at $65, I buy 10% of my cash position. $60, another 20%. $55, 30% more. $50, final 40%. This is scaling in. You don't catch the perfect low. You build a position across multiple levels so your average entry is solid. Set those levels in advance. Before emotion kicks in, write them down. $65, buy 10%. $60, 20%. When the moment comes, execute mechanically. No thinking, no second guessing. Follow the plan. In a crash, when silver's dropping $5 an hour and everyone's panicking, your plan saves you. Final third goes into long-dated call options, specifically leaps, options with expirations 12 to 18 months out. When you buy a call, you pay a premium for the right to buy silver at a specific price by a specific date. Silver at 72 today. You buy January 2026 calls with an $80 strike, you pay maybe $8 per ounce. That's your risk, $8 total. If silver runs to $100, your option is worth $20 $20. You made $12 on $8 invested, 150% return. Compare to futures. Futures get margin called when you're wrong. You lose everything. Options, you lose your premium. $8, no margin calls, no forced liquidations, no brokers selling you out at terrible prices. Option expires worthless and you move on. That's the beauty in manipulated markets. Upside leverage without unlimited downside. My specific setup, silver at 72. Buying January 2026 calls, $85 strike. Why 85? Conservative. Room for silver to run before options profit. At the money, options at 72 are expensive and decay faster if silver drift. 85 strikes are cheaper. $13 of cushion. If silver hits 100, my 85 calls are worth at least $15 each. How 3/3 protects you in every scenario. Scenario 1, silver crashes to 55. Physical is underwater but can't be forced out. You own the metal. Cash deploys at predetermined levels, averaging down, building bigger positions at better prices. Options lose value, but you only risked 1/3. You survive. Scenario 2, silver rallies to 100. Physical bought at 78 is up $22 per ounce. Cash bought at 65, 60, 55 is massively profitable. Options at 85 strike worth at least $15 each. You win across all three. Scenario 3, silver sideways 6 months. Physical holds value. Cash sits ready, not losing anything. Options decay, but you sized appropriately. You're still in the game. Hit that like button again, comment which third makes most sense to you, and subscribe for the follow-up on exactly when to exit these positions. What not to do. Do not trade futures unless you're a professional with deep pockets. 8 margin hikes in 8 weeks. Trading halts, circuit breakers. The game is rigged against retail. They change rules when you're winning. They lock you out when you need to exit. Stay away. Do not buy mining stocks now. Silver crashes 15%. Miners crash 30%. Leverage to metal price plus company-specific risk. Management issues, production problems. You're playing a squeeze. You don't need extra risk of CEO competence or mine floods. Keep it simple. Physical and options. Do not go all in at one price. I don't care how good 72 looks. Nobody knows the bottom. Scale in. Use cash to build over time. Average down if wrong. Average up if right. Never everything at once. Here's the mindset. You're not getting rich overnight. You're positioning for $100 without liquidation on the way there. That means humility, accepting you don't know the exact bottom, building a strategy that works whether silver hits 55 first or rockets to 100 tomorrow. 3/3 gives you that flexibility. Physical for safety, cash for opportunity, options for leverage. 3 independent positions protecting you from manipulation, volatility, and your own emotions. This is how you survive rigged markets. This is how you profit when paper diverges from physical. The silver story isn't over. The $100 target is real. Supply deficit is real. COMEX vault drain is real. But getting there requires more than being right. It requires a strategy keeping you in the game when they shake you out. Use 3/3 rule. Protect yourself. Position for what's coming.